Hi everyone, and welcome to this new video. Today, we're going to dive deep into 6 different investment strategies to boost your ETF game. Here's the table of contents for the video, with the 6 strategies we're going to study. Let's start with the first one. Buy and hold. It's the simplest and most popular strategy. You invest in a diversified set of ETFs and hold them for the long term. You can check out this video, where I show you how to build a solid ETF portfolio. The idea is that, over time, markets tend to go up, so staying invested pays off. Now let's talk about the pros and cons. The advantages. It's very simple, and the costs are low because you just buy and wait, so there aren't many transaction fees. Plus, you benefit from compound growth. As for the disadvantages, there's not much flexibility. For example, you might feel stuck if there's a market crash. And you could miss some opportunities because you're following the same strategy for years, no matter what happens. Alright, let's backtest the buy and hold strategy from January 2016 until today. We use a portfolio made of 60% Vanguard Total Stock Market Index and 40% a Treasury Bond ETF. We can see that the annualized return is around 9.7% per year. The volatility is about 9.8%, and the maximum drawdown is 19%. If we scroll down to the equity curve, we can clearly see that the market tends to go up over time, even with events like the COVID crisis and the 2022 inflation. So, buy and hold is definitely a powerful strategy for long-term investing. Let's now talk about the momentum strategy. It's all about investing in the best-performing ETFs. You invest in the ones that have performed the best recently. The idea is that winners tend to keep winning, at least for a while. Each month, you update your list and move your money into the strongest performers, so it does require more monitoring than the buy and hold strategy. Now for the advantages. You can capture trends, for example, an AI trend or a defense sector trend. And there's potential for higher returns. As for the disadvantages, there's a whipsaw risk, meaning you might buy an ETF just when the momentum is over. Also, you could underperform during sideways markets when there's no clear trend. Let's move over to TradingView to apply this strategy. Here, under Products, we select Screeners, then ETFs. We land on this page, and now we need to filter our search. For example, we want entire world ETFs, with assets under management above 500 million. And in the strategy filter, we select Momentum. This way, we only get ETFs that apply a momentum strategy by selecting stocks with high momentum. Then, we sort by descending return. And in the column settings, we select 1-year return. As we can see, the best performer is the Invesco S&P 500 Momentum ETF, with a 1-year return of 41%. But since this ETF only focuses on large cap, we might miss out on great opportunities. That's why I personally prefer this ETF from iShares. It delivered a 35% return over the past year and focuses on the total US market. Let's check out on the iShares website the MTUM ETF. We clearly see that the investment objective is to invest in stocks exhibiting relatively higher price momentum. If we click on Performance and Distributions, we can see that the year-to-date return is 17%. Over the last month, it delivered 4%, and over the last 3 months, about 20%. Since inception, the total return is around 440%, which is pretty impressive. Now, if we look at the holdings, we can see that Broadcom has the biggest weight, with 6% of the portfolio. The second largest holding is Meta, with 5.5%, followed by JP Morgan, Netflix, Walmart, and so on. Now, if we backtest our momentum strategy with 40% allocation to Treasury Bond and 60% allocation to stocks using MTUM ETF, we can see that the strategy generates more than 10% per year. And if we compare this performance with a classic buy and hold strategy, that's the blue line on the chart, we can see that our momentum strategy outperforms the buy and hold approach. Let's now see what the opportunistic strategy is about. It's a short to mid-term approach where you try to spot near-term market trends or themes like clean energy, AI, or a rebound in emerging markets, for example. It's a more hands-on strategy and often involves short-term trades. The advantages are you can benefit from tactical positioning and ride big trends, like the AI rally we saw in 2021, and it can potentially deliver high returns. The disadvantages? It's hard to backtest because it's more about following your intuition, news, and spotting opportunities than following strict rules. So, it requires a strong market intuition.
Let's analyze an opportunistic strategy.
Yesterday, I spotted some good news. For example, Shanghai stocks closed at their highest level since 2021. Thailand's inflation falls below expectations in July, and Brazil's economy seems ready to ride out the 50% tariffs. That's good news for emerging markets. So I decided to take a look at the Vanguard Emerging Markets ETF, and I spotted a solid opportunity on the chart. There's a clear uptrend here, with 1, 2, 3 rebounds. Plus, the latest rebound occurred right at this level, which used to be a resistance and is now acting as support. Finally, the stochastic indicator shows a bullish crossover between the two lines, happening below the 20 level. It suggests the pullback has ended and the uptrend is back in motion. That's why I decided to open a long position at the open of this candle. I placed my stop loss just below the support, and I'm targeting a risk-reward ratio of 2 to 1. Now I just have to wait and see if this opportunistic strategy turns out to be profitable. Okay, now we're going to study the value strategy. This one focuses on undervalued sectors or regions. You invest in ETFs that have underperformed, but their fundamentals still look solid. You might look at ratios like price to earnings, book value, or earnings growth. The advantages: you're buying an ETF at a discount price, which means it has strong potential for appreciation. And generally, value companies offer attractive dividends, so you can get quarterly payouts. But be careful of value traps. Some companies may look undervalued, but they never actually go back up. This strategy requires patience and confidence in your approach. All right, let's find an ETF to invest in underestimated stocks which have strong fundamentals. If we want to focus on global market using a value ETF strategy, and if we sort the list by 1-year total return, we get the top performers right here. This iShares ETF is one of the most well-known for investing in international value companies. It has billions of dollars in assets under management, strong returns this year, low fees, and it focuses on the total market. Let's analyze this ETF by clicking on the EFV overview. We land on this page. If we scroll down, we can see the key stats. And since it's a value ETF, there's an impressive dividend yield of 3.55% per year. Here we get info about the issuer, which is BlackRock, and there's also a link to access the product's homepage. We can also see the geographic exposure of the ETF. As you can see, North America is excluded. It mainly focuses on Europe, the Middle East, Asia, and Oceania. The top 10 holdings are all international companies. And here we have technical signals. The oscillators are neutral. The summary is a buy, and the moving averages show a strong buy. So technically, it could be a great time to invest in this value ETF.
Now let's talk about the macro strategy.
This one is all about riding macroeconomic trends. It means you look at macroeconomic indicators like interest rates, inflation, GDP growth, geopolitics, and so on, and you make investment decisions based on those signals. For example, if inflation is rising globally, you might decide to overweight commodities or inflation-linked bonds, because risky assets like stocks could go down. Now, the advantages. You get a big picture perspective, and it's one of the best hedges an investor can have. It's also a crisis-resistant strategy, because by following macro indicators, you can sometimes anticipate downturns or major shifts. As for the disadvantages, It's sometimes really hard to time the market correctly, and your decisions can arrive too late to take full advantage. Alright, if we go to the Trading Economics website, there are plenty of macroeconomic indicators available. The main indicators are listed right here. For example, if we take a look at GDP growth rates, we can see that Indonesia had the highest growth over the past year, followed by the United States with 3% per year, and then some other emerging countries. Now looking at interest rates, we can see that Switzerland stands out. Borrowing money there costs 0%, which makes it the most attractive in that regard. It's followed by Japan and so on. When it comes to inflation rates, there's a world map available. We can see that Argentina has the highest inflation, close to 40%. In general, inflation is high across South America, parts of Africa, and the Middle East. Russia also has a relatively high inflation rate at 9.4%. The regions that look more stable in terms of inflation are Asia Pacific, Europe, and North America. So, better idea to invest in it. Another important indicator is the unemployment rate. For example, Singapore has only 2% of its population unemployed, followed by Russia, Japan, and a few others. And finally, one of the most important indicators to assess a country's macroeconomic and financial health is the balance of trade. The world's largest exporter is China, generating around $115 billion from international trade. On the other hand, countries with trade deficits usually send a weaker signal economically, and it's generally not a good sign for investment. To summarize, you should always take a look at these key macroeconomic indicators to get a clear overview of the global economy, and to better decide in which geography or sector to invest your money.
Let's finish with the core satellite strategy.
In this approach, you combine multiple strategies. You create a core portfolio that's your main foundation, and around it, you add small positions with more tactical ETFs. These smaller, more flexible positions are called satellites. The advantages: you get great diversification across your overall portfolio, but it does require more involvement and regular monitoring. For example, let's take a core satellite strategy in practice. Your core strategy is buy and hold, and you allocate 75% of your money to it. Then you allocate 10% to a momentum strategy, and another 10% to an opportunistic or short-term trading strategy. Finally, the remaining 5% could go into value stocks that pay high dividends. Okay guys, that's the end of the video. Thanks for watching. I hope you learned something valuable. See you soon in the next one, and don't forget to subscribe.